So today I want to talk about the latest US GDP figures and the Australian CPI figures that came out this week. So please note, as always, everything discussed here is done so for entertainment purposes only. I've not taken into account your personal circumstances nor your risk profile, so you should seek professional advice before making any investment decisions. So today I'm going to talk about the US GDP data and the Australian CPI data. And so there were some, big pieces of data that came out this week. And so we're going to talk first about the Australian CPI data. CPI, is the basic sort of inflation measure that's used by the RBA. And basically the CPI over the 12 months to the March 2022 quarter, CPI actually rose 5.1%. And RBA typically targets a band of 2 to 3%. So it is above their targeted band at this moment. And that is typically the way that they actually measure whether they should be doing rate rises or not. So this is quite an important figure that came out this week. Now, in terms of the actual underlying drivers as to why the cost went up so much was two main items, one being owner-occupier new dwelling construction costs. So, the cost of tradies, materials, everything like that increased dramatically, up 5.7%. And then automotive fuel, so obviously with all the stuff happening with petrol prices, that's obviously making prices go up quite a lot there as well. So those are key figures, and basically the CPI index rose 2.1% for the quarter. Now, the RBA uses a more normalized range for this, which I believe came in at 3.7%, but it is still important to note that headline number there. And then by comparison, if we look at wages, so the Q1 data is not out yet, but the Q4 data is out, and wages only rose 0.7% for the quarter and up 2.3% for the year. And both private and public sector were both growth rates of 0.7%. So basically, there is some wage growth occurring. And they are expecting, or at least hoping, for there to be further wage growth. But you can see there is some discrepancy here between CPI and the actual wage growth figures. And so, they now expect that it is going to, potentially narrow, but that's yet to occur. So we'll have to see how that plays out over the coming months. And basically with that, if wages don't increase and we have a high level of inflation, that's when we can get stagflation and basically a very stuck economy. So we very much want to avoid that. Now, if we look a bit deeper into the CPI data, we can see the Australian property market has already been cooling off a little bit. You've probably noticed, in a lot of areas, the stuff isn't selling on the same day it gets listed and that kind of thing anymore. So, I think that the CPI part of the calculation based on those owner-occupier costs may start to cool off a bit as well. So, as there's a little bit less demand in the housing space, then that'll probably calm that part of it down. In terms of food and fuel, look, this is harder to sort of forecast what's going to happen, but I am in the camp that really believes that we are going to see, higher food and fuel prices as a new normal. And while the RBA's core normalized inflation was much lower than the headline figure of 5.1, it was still way above their upper band, which is the 3%. So where things are at here, it isn't anything like the US's current inflation rate, but there are, a lot of calls being made about the RBA putting rates up. And so it seems highly likely we will see some rate rises in the near term, say in the next couple of months, potentially over the next year. They might, be doing a number in a row. And I think this is going to be quite negative for the economy in the short term. Now, that's on the home front. If we look over at the US GDP data came out this week, so gross domestic product came out for Q1, and it was expected that the US was still growing. It was expected that there was still going to be a growth rate of approximately 1% for the quarter, and the last quarter, so Q4 2021, was a growth rate of 6.9%. So this is the US I'm talking about here. However, the actual data that came out for Q1 was GDP already contracted 1.4%. So that is huge news and very, very negative, showing that even by the end of March, the US economy is already in a it's significantly contracting already. 1.4% may not sound that significant, but if that turns into 3%, 5%, 7, 10%, if your economy is declining at a 10% rate, you don't exist in 10 years. Give or take, but more or less, you can see that this is something that they won't want to let get out of control. It can be very grim in terms of where it goes. So, I think that, we need to be aware of this, and I think this was a bit of a shock to the markets in terms of what the expectation was, and we have seen quite a bit of volatility in the financial markets on the back of this news as well. And so it is important to note here that, in the US, they are just at the start of their rate tightening cycle, as they're speaking of at the moment. And, to already have that negative GDP print begs the question as to how much they will let the economy contract and for how long they will before they start talking about, quantitative easing again. So I don't think that we've actually seen a real decline in the quality of life for the middle class in sort of the West since World War II. While the sort of commentary at the moment is that the thought is that a few rate rises will sort things out, I personally have a different opinion. I think there's going to be much higher cost of living. I think there's going to be protests and riots around the world, as we've already started to see in some locations, as the higher food and fuel costs are just too much for some to stand, and then this is going to cause more instability across the world. And so while all this sounds very negative, it's important to know that I think there was a saying, I guess I heard a while ago, something along the lines of that a recession is a transfer of wealth from the poor to the rich. And so basically, at these times, this may be where poorer people may be too scared to hold on to their assets, or they may not have enough liquidity to be able to hold on. And that's when, potentially the rich will come in and scoop up and buy all these assets. And then, you can obviously see how, things play out in time. And I think which side of the transaction you want to be on. I guess the biggest challenge with this kind of thing is that, we don't know where the bottom is. We don't know the perfect time to buy. I was working in finance during the GFC, and so I literally lived through and was speaking with clients every day as they went through the crash back then. So I have seen significant carnage before, and I believe it is possible again. But what I learned from that was that, a lot of people got forced out of assets they owned, and then, fast forward 5 years, they could see the big difference in valuations there. So who knows if we're anywhere near the bottom. Some bad prints in terms of GDP. There are a lot of concerns, I guess, around rate rises. So the current mood of the market isn't the strongest. And so I think that, there may be opportunities that present themselves in the coming months or years. And that may, set us up to make some good investments that'll look good in 10, 20 years' time. So difficult times ahead, and not all optimistic news, but hopefully some of this today was of value. And please note, as always, everything discussed here is done so for entertainment purposes only. I've not taken into account your personal circumstances nor your risk profile, so you should seek professional advice before making any investment decisions. And I really appreciate you tuning in as always. Thank you so much.